Good morning, ladies and gentlemen. Well, nothing really significant going on with the model. It's still firmly in risk on, although it's oscillating between the highest bin and the one next to it. I don't think it's very significant, but what it does say to me is that we are likely to see a period of sideways consolidation. As you can see, it does tend to dip, to go sideways around this period for a total of about 20 days, which would make sense because now we're waiting really for the FOMC and to see if they're going to change their dot plots. I don't think if the FOMC was held today that the dot plots would change, but that is in the lap of CPI and to a lesser extent NFP. That happens next week and the week, not next week, but the week after that, and the week after that one for CPI in the middle of March. So we are really in a holding pattern now for assets just to see if the Fed changes its path of easing and the dot plots. Just a very quick reminder, these are the dot plots from the last FOMC. And now, having had the figures for January, February, we really have to see if the excuses that we've been making for CPI, i.e. it's seasonal factors, it's a one-off and all that, hold. Because if we get a second print which suggests that inflation is not going down the way they would like it, the odds are that some of these people down here revise their projection to slightly higher, which would give us two cuts during 2024 and would have the central tendency up here at 490. I don't think, as I've said, that that is the situation at the moment, but the Fed has the luxury of waiting. And Waller did say that, where's the hurry? And therefore, the odds are that if the next set of data is not as good as the market anticipates, that somebody will move those dots higher and this will compress and the median will be at 480, 490. And that would have real impact on the market. And let's have a look how. So here you have the three cuts starting in June, then September, then December. And as you can see, we are right on top of the fair value in terms of SOFR. So it's maybe slightly higher, 6.5 ticks, which is really nothing, all the way out to H5. Z4 is 6 ticks, but U4 is right on top, and that is why it was wise to cover those positions. But let's have a look at what happens when you do change these, and you go from 3 to 2. The Fed might easily decide that this is a 0 and that it starts maybe a little bit later and it goes to 0 here, and when you get that, you will see how much rich we are. In U4, we're still 26 rich, and in Z4, we're 20 rich. So you can see what the impact would be. To me, at the moment, the short end of SOFR is absolutely stuck until we get the CPI. Probably the NFP is going to have a little bit of effect, but it's the next CPI that we're waiting for. And until the next CPI comes along, we are in a holding pattern at the very short end, which just means that the only thing that can move is the yield curve. And the yield curve won't move that much because itself, it's waiting for the CPI. So this is a 300-minute chart of Z4, and I think that for the next 2 weeks we are stuck between this kind of level, which is 96.40, 45, and this kind of level, which is 72. So that's 25 basis points of trading range. I will sell it all day up here around 70, 72. And really, I see no point in trying to push it below this 45 area. We are now stuck for the next 2 or 3 weeks until we see the CPI. And until we've seen the CPI, this will not change, as I've shown you, because we just can't change the dot plots. And until we can change the dot plots, this contract is dead, which also means that it's an anchor, which also means that the only thing that can change is the yield curve, and how much will the yield curve move. So now this is 2's tens. It's unlikely that we get a steepening bias, while the fear is that the Fed changes its dot plots upwards. It's more likely to drift higher in a flattening rather than start steepening at the moment. So that's 2's tens. I would have thought that at some stage it trades 47 to 50 area, but I don't expect it to go through there until and unless you get the new CPI print. So now this is 5's 30s. What do I expect it to do? I expect it to touch this around the 5 area, -5, maybe get to 0, but that's about it. I know the supply is there next week in 2's, 5's and 7's, so the 5's should be the weakest area on the curve until about Tuesday, and then it should normalize again. But I don't think we have a lot in it. We might have 4 or 5 basis points, and then it should remain stable in this area, waiting for the CPI. So I don't think that the curve is really going to move that much. I think at this level, it's probably a good risk-reward short, simply because we don't know what the CPI is. We will only exceed this level, I think, after the CPI and if it's bad. So I wouldn't count on the yield curve to move that much, maybe 5, 6 basis points, but that's about it. Given those expectations for yield curve movements, it's really not surprising that all we have done is taken out the candle from the Fed day, which is this one, and we are basically at the same level as we were on the FOMC day in December. And we're now waiting for the new FOMC. I would expect 2's to be right around here, and therefore trade just like I showed you the SOFR, probably in a range from 455 to 475 for, an extended period of time, something like here. This is, 2 weeks worth of action, and that's exactly what I expect. The 5's, they have taken out the Fed day and a little bit more. Maybe they drift up a little bit more into this area simply because of the supply. But I really would not be looking for much more than that from the 5's, because don't forget that those are going to be affected much more by the terminal rate. I know the terminal rate will change slightly if the Fed moves its dot plot, but it's too early to be able to tell that the terminal rate will not be the same. It could be just that the cut is postponed from 2024 into 2025. So I really would not expect the 5's to move that much, and I think this kind of area around the 438 to 442 area is going to be enough to cap them for the next 2 weeks. And if we look at something like the 10's, I would expect more stability in this 438 440 area. I really don't see any reason for them to go through it. I'm a better buyer of bonds at these levels than seller, because I just don't see the risk reward in trying to push it any higher, because I don't think the yield curve is going to allow it. And I just don't see that the market is ready to give up on the terminal rate of the cuts, which, as we all know, is around 175 basis points at the moment from 535. So why would we push now? It just makes very little sense to me. We have precisely the same kind of picture in the European rates. We've taken out 50 basis points of cut expectations in the twos. I mean, that is a lot. To me, the odds of it going through 3 to this 299 level are very, very low. And you can see what it did on Friday. It basically did some kind of a reversal pattern. If we see anything approaching 292, 293, I am sure that over the course of the next 2 weeks, basically we're stuck in a 275, 295 range. Just like the SOFA Zs. And if we look at the bubble, it got exactly to this 0.618 retracement of this whole move. And now it's going to be in a holding pattern. And the Bund, it never quite got to my 252 area that I thought was, a fantastic risk reward. But it did in the much better technically trading oat, and this level worked superbly around the 261 area. I think this 261 will not be broken anytime soon. Any kind of return to that kind of level, I am a big buyer. I think the odds are that at some stage again we trade, this range to the, what is it, 296. 296 to 271. I think that is the established range at the moment for the oat, and therefore much the same kind of range for the Bund. What is interesting is that the Italian market is also reversing, and the spread between Italy and Germany is breaking down. Why is it breaking down? It's the carry. Okay, look at the yield of the Italian 380. So you have, it pays you, you have positive carry. It pays you to buy the Italian bond and wait. So you have duration and you have positive carry. With the German bond, you have negative carry against, day to day. And therefore, this spread is being compressed. There is no crisis at the moment in Italy that the market has to worry about. So where are we going to go? Well, we're going to go back to something like this area. And this area is 132, maybe 130, maybe 129. So it just does not pay to fade the upward pressure in Italy at the moment, simply because it has positive carry and the market is anticipating cuts, and therefore it wants duration, and therefore it will keep on buying the Italian bond. And if we look at now Italy, I am convinced that it won't break this 368 level by very much, but that is the natural tendency. Every time it goes up towards 4, it's a great big buy for 368. France and Italy are just better buys on any kind of dip in the futures. Germany against the US is at the moment a complete mess. This is twos. I just don't think we're going very far in it. Fives, same story. I think we're stuck between this 173, 74 area and this 205 area. I just don't see us moving out of it. Tens, the pressure is non-existent really for big breaks. What is interesting is this is 5s US against 10s in OAT. And that pressure is to the upside. Will it go very far? I doubt it. I think it's going to, just basically trade. The fives are subject at the moment to the technicals, and that's why we did the trade a couple of days ago, simply because of the auctions. Once the auctions are over, I would expect this to dip back down, and then we probably have another go at it. But to me, buying Italy and France on dips is a great trade, just like selling the twos and fives will be a great trade in the US when we get to those levels where the SOFR becomes rich, i.e., when the SOFR is trading 20 basis points higher than it is at the moment. So I really think that we are stuck at the moment in a 20, 25, 30 basis point range. And to me, that still means that the move index is stuck. And you can see that for the past 2, 3 weeks, we've really done nothing. And when will we be in a position to really, really rally in bonds? Well, not until we start taking out this area, 97 to 89. That will be when we are ready, and I'm sure that the move index will give us the timing for the bond market. But the bond market isn't going to rally substantially until, one, the Fed starts cutting, and B, we know that inflation is more than under control, i.e. inflation is going to go probably below 2%. Because until then, and what is most likely to happen is that the yield curve will take most of the strain, i.e. it will steepen. Twos will rally with the Fed cuts. But because of the huge amount of supply that the bond market has to absorb over the course of the next 2, 3 years, so the supply just keeps on coming and coming and coming, I would expect that it will be the yield curve that will take most of the strain. And therefore, I am looking at the move index to give me the timing for the short end to start rallying much more than the long end. The Dixie is doing exactly what it should be doing in a period when the interest rate differentials are completely stuck and the bond market is basically stuck in a 25 basis point range waiting for the CPI. It really is something between 103 and really 102.82 on a big dip and this 104 area. That's your trading range, 2-3%. And if we have a look at what that implies for the Euro USD, it's really not going to go much higher than this 109 something, and really any kind of a dip towards 107, 10, 15, you might get a 106, what is that, 106.70, but there it's a buy. So basically you are not looking for any kind of big move in Euro USD, and you're not looking for any kind of big move in FX at all. If interest rate differentials are stuck, if bonds are stuck, if the dollar is stuck, gold is stuck. Look at these Bollinger Bands now come in. It's going to be a 2080, 1990 range. What do you want to do? It's that kind of a market. Don't push it. No reason to really start, thinking that it's going to trade out of that range. So just leave it alone and trade the range, or sell strangles, sell straddles, whatever. I don't think for the next couple of weeks until CPI, this is going to be very far away from 2000 to 2050. That's your range. The one I really can't understand is DBC. If the economies of the world are doing just fine, like the equity markets think, then DBC just should not be this weak. It's breaking the 2175. I mean, it's broken it by a tick on the close, but what is significant to me is that it keeps on getting sold. I mean, it just keeps on getting sold all year. It rallies nothing and it gets sold. It rallies nothing and it gets sold. In this case, I see very little hope that it won't trade down to this 2057 area over the course of the next couple of weeks, and that should really make bonds levitate, because it really is telling you that there is no inflation in the system. you know and look at gold against DBC. It's beginning to break out. All the moving averages are positive, and it's getting to the level that it had difficulty taking out. And if it starts taking it out, then you're looking for these levels, right? 930, and that is a big move. And then you're looking for something like 994, and that's in percentage terms, that's big. So it's saying that DBC weakness and gold doing nothing, you need almost a 10% move in DBC. And I can't imagine that if you get a 10% move down in DBC, that is not going to have a positive effect on bonds and inflation in general. So, I'm a bit worried why this is happening, because I just don't understand why it's happening. I mean, oil is not all that bad. Yes, it just can't break this up, 80 area. And it's more likely now, if DBC is right, to come right back down to this 71, 72 area. And that would be probably enough for DBC to give up the 5 to 10% that it needs for gold to go up against it, and basically trade this moving average again around 72. Well, why not? So, but all that would encourage bonds to get bid, but it also should put some doubt, at least doubt, into the mind of equities as to what is going on. Why are these commodity prices so weak? As you know, last Thursday and even Friday morning, I sold tons of calls against my long book, and I really am uneasy about what is going to happen to equities over the course of the next 2-3 weeks. I don't think they're going to collapse. I just don't see how a very weak commodity market does not put some doubt into people at these levels about equities. And I also think that we might get some month-end rotation from equities into bonds, which should keep equities stable at the very least. I mean, when you look at this kind of chart and this kind of overboughtness in the on a weekly basis, it has to give you some pause for thought. But what I would very much like to see is a return to this moving average and then a catch at this red moving average. Whether we'll get it, I don't know. I just know that on a monthly basis, the upper monthly Bollinger Bands comes in around 4,900. So we are, what are we, 200 points above the monthly Bollinger Band. That's 4%. I mean, it's not a million miles, it's 4%. So I would like to see a 2 to 4% dip in the equities over the course of the next 2, 3, 4 weeks, maybe discounting A, the weakness in the commodities, but B, also the possibility that the Fed moves its dot plots, and therefore that the short end market is, has to collapse 25 basis points, as I showed you, But that won't happen until the FOMC. So the equity market should really, start discounting a little bit the possibility that the Fed goes later. And, how far that moves us, I just don't know. I just find it very uncomfortable at these levels. What I would like to see probably in the next 2 weeks is a move back down to this kind of level, 50-20, 50-30, allowing these moving averages to catch up at the very least before we start moving back up. I'm finding it very difficult to be long. Where is the pain trade in the NDX? Well, to me, the pain trade is now, having taken out all the stops that must have been above this high, that, the market just goes sideways and has brief dips to fill these gaps down to, this 16,970. Will people just keep on buying the Nasdaq at these levels? I find it hard to believe that they will, simply because all the news is in the price. The Netflix fantastic earnings are in the price. What has Nasdaq got to look forward to at the moment? It just doesn't make that much sense to me to be long of the Nasdaq and the SPX at these levels. I just think the waiting game is one that you play by being in cash rather than being in equities. So until I will not be able to buy the Nasdaq or the SPX until I've seen the FOMC, or at the very least I've seen that the odds of the FOMC moving the dot plots are next to zero, because the next CPI number is good. Europe has also met my 48-49 target. I am finding it very difficult to be long of Europe now. What can I say? I would like to see a retracement. We are so far away from everything now that a retracement seems to be the natural thing to expect. We are above the daily Bollinger Bands, we're above the weekly Bollinger Bands. A return to the very least to this 4800 area. And that's not a big buy, right? On a monthly basis, you would want to buy it somewhere around here, 4700. And you can see where 4700 is on a daily basis. So maybe an ABC down to 4700, who the hell knows? I just find it very difficult to be long at these levels. Don't see the point. The one market that's not doing anything wrong is EEM, but there, let's call it the dividend yield, or the whatever, the multiplier that it trades at, is so much lower than in the US or even in Europe or anywhere else, that maybe people are buying this as a 2-3 week play to get out of the very, very expensive markets. I don't know. I just know that it's not doing anything wrong, and my objective would be something like 42.25 before you get completely out of that one too. So maybe that is the play, that people will swap the very expensive markets like Nasdaq for something much cheaper like EEM, and just sit in it for 2 or 3 weeks until they know what the Fed's going to do, and then reallocate again. That is a distinct possibility to me. I just know that this market looks a lot better and has gone absolutely nowhere for so many years that it's probably playing the risk reward a better bet over the course of the next 2 or 3 weeks. I don't think it's a better bet over the course of a year, but over the course of 2 or 3 weeks, maybe yes. And there are a couple of indicators that not all is good in equity land. This is the SOX index over the yen, and it's a very fast and early indicator of the trend. It did a bit of a key reversal on Friday, just like it did it here, and every time it does it, if you look, it goes 2-3%. it's you are not seeing any broad risk off by any stretch of the imagination. Okay, none. What you are seeing is some early warning charts in some very fast risk indicators that say that maybe the next move is going to be a quick 2, 3, 4% to the downside to basically stop everyone out. That is the only thing that is making sense to me. I'm not going to play it in very large. I still think it's a much better buy in equities when they reach certain levels. So the way I'm playing it with my long book, I'm keeping it. I'm just selling a whole load of calls against them, and hopefully in 2 or 3 weeks' times, those calls will be worth nothing. And if the market is 4 or 5% lower, I get to buy the calls back and basically add to my call positions with cash. That's the way I'm playing it, but doesn't mean that that's the way you have to play it. But I just think I want to tell you that there are early indicators that I'm seeing, early fast indicators that say that the equity market is due a bit of a bath. And with that, I've changed all the levels. I think the message from this video is that the curve is unlikely now to start steepening until the CPI. And if the CPI is bad, you will probably get another bout of flattening, as I showed you with those SOFA prices if the Fed changes the dot plots. I don't think that we're there yet, but if that CPI number is bad, and to a lesser extent the NFP, then the odds increase exponentially that that is what is going to happen during the FOMC. I don't think anything happens before the CPI more than a 20-25 basis point range, and we'll just play the range. SPX and especially the European market, I'm nearly completely out of it via the calls that I've sold. I find it very uncomfortable to be long of equities up here for the reasons I've stated, and the one that really worries me is DBC. I just cannot triangulate a very strong world economy with very weak commodity prices that are likely to fall 10% over the course of a couple of weeks. What on earth is going on? So as that is a problem, I would much rather hold gold than DBC. And if that is the case, then I much rather hold bonds over equities in some ways. And since I'm seeing some early signs of weakness in the spreads, then I'm really, really uncomfortable with holding, especially NDX or SPX. I'd much rather be much more defensive for the course of the next 2 weeks. Thank you very much indeed, and tweet you tomorrow.